Well, Brian may be saying that some of his guests have pointed to a cautiously optimistic outlook, but our next guest says China's economic slowdown could be the single largest factor in creating a global recession. Let's bring in Josh Lipsky. He is the director of the Atlantic Council GeoEconomics Center. And Josh, Brian pointed to what he has heard from in some of his interviews, but we heard the managing director of the IMF say the global economy faces the biggest test since World War II today to kick off Davos. How much of this do you think is largely going to be driven by China?
Well, a lot's going to be driven by China, and thanks for having me, Akiko and Brian. But, we have to take a step back. I know this is the first summer session of Davos in a long time, but from a macroeconomic perspective, this is an extraordinarily gloomy outlook. So slow growth in China, and we can talk about that, soaring inflation, and now these numbers out of the US, which raise fears of a recession, food shortages around the world, the risk of emerging market defaults. So all of this at the same time, slowdown in Eurozone, US and China, those three anchors of the global economy. We haven't seen a situation like that. So the confluence of events, and Kristalina Georgieva, the head of the IMF, said confluence of calamities, that in and of itself should give everyone a lot of pause entering into this Davos. And I know that, we look back at Davos, the last time they all convened in person, January 2020, right behind the curve before we're about to see with the pandemic. Let's hope we're not in for a repeat this time. But a lot of the economic stresses we thought were going to happen at the beginning of the pandemic in terms of debt default and economic distress were put off because of fiscal and monetary stimulus. We don't have that now. And now we're dealing with the realities economically we thought we'd be facing 2 years ago.
And also, Josh, when you think about Davos, this has typically been a gathering of world leaders, business leaders, to really push for this idea of globalization. And yet increasingly over the last year, and even more so this year, we have seen what some would call a type of decoupling that's happening, onshoring more and more, sticking to what the Biden administration has called those with similar values. How much of that do you think tests this idea of a concerted effort to keep the economic recovery going globally?
Well, it's ironic that the term of the week in Davos is going to be deglobalization. Imagine saying that 2 years ago. But that's what these business leaders are talking about on the promenade and in the after parties. What does friendshoring mean, as Secretary Yellen has talked about? How's that different than ally shoring? What about regional trade arrangements and plurilateral trade arrangements? This is a very different Davos than a few years ago. And the question is, how much is that going to happen in the next few years, over the next decade? What transitions out of China? As usual, there's a lot more talk than action. But we look at, what's happening in Vietnam, for example, in terms of supply chain. So there will be winners in this reorientation. They will not happen overnight. And the question for business leaders at Davos is who will be the winners and who will be the losers? But we are entering a different period of the global economic environment than we've been in over the past 20 years. And Davos has to recognize that.
Hey, Josh, Brian Chung here. More talk than action seems to describe most of Davos of years past. But all of this is kind of thematic to the news that we're getting out of Asia, with President Biden making a push for that Indo-Pacific Economic Framework, or IPEF. That's very much thematic to what could be an alliance against China, especially as some of that friendshoring perhaps incentivizes companies to go elsewhere. What do you see as the big difference between that IPEF and the TPP, the Trans-Pacific Partnership that people were talking about not so long ago?
Yeah, no, it's a great question. We should be upfront and say IPEF is not a traditional trade deal because it doesn't offer market access, right? So this is very different than TPP or its successor once the U.S. withdrew, CPTPP. That being said, it's good to see the U.S. engaging in trade and economic and regional integration. And they have every major economy you would want signed on to it, at least at the outset, 40% of global GDP. You have Singapore there, you have Malaysia there, you have Vietnam there. So that's a success for this administration. But devil is in the details, right? They've just announced the framework, cooperation on issues like climate and technology and early warning on supply chain. All good. But when push comes to shove, when these countries maybe need to choose between an increased RCEP deal with China or China involved in CPTPP, and will that force a difference between this framework? This framework doesn't offer as much economically at this point as those deals do. We'll see if that continues in the months ahead.
Well, I mean, that is the key question because the U.S., after withdrawing from TPP under President Trump, I mean, some would argue in Asia, they've largely been absent on those trade talks. And so how effective can a framework like this be when it doesn't really offer the very thing you mentioned, the number one thing these economies want, which is market access into the U.S.?
Well, it can only be effective as the beginning of something, not the end of something. So if it can be a signal from the US that they want to re-engage in the region economically through a coordinated trade mechanism, then that's a positive. But if in 2, 3 years, 4 years time, we don't see anything more than this framework outlines now, then that won't be a success. So I think a lot of reasons countries have signed on is because they hope over time, and you actually heard this out of Singapore today, that the US political situation changes and this can become a larger trade deal. Whether that happens or not will be the true test of IPEF over time.
And Josh, lastly here, I want to ask just kind of big picture here, because if we kind of smash the two themes that we were talking about with, concerns about Chinese growth and the spillover effects, but also this friendshoring impact of people trying to stake sides here, does that mean that this kind of deglobalization process is going to have to come with slower global growth as the world's second largest economy perhaps gets isolated?
Yeah, I mean, let's just step back and think about this. No one really agrees what it means to have a global recession. Economists debate this. It's different than a domestic economic recession, 2 quarters of negative GDP growth. But let's say your baseline is 2% GDP growth as a global recession. We've had 4 of those in the last 40 years. In each of those, China's been growing around 8%. That won't be the case if we get into this global economic recession scenario in 2023. They'll be growing at 3%, maybe 4%. So think of what that means if you have recession in the US, recession in the Eurozone, and now recession in China, the world's second largest economy. It's a very different dynamic, and your friendshoring, your reshoring looks very different in that scenario. And this is where you look at emerging Asia, which is why I think what we're talking about on the trade side is so important. It's a different kind of recession and then a different kind of recovery on the back end.
Josh Lipsky, Atlantic Council GeoEconomics Center Director, thanks so much for taking the time this morning.
Thanks.
Appreciate it.